because the time at your disposal is very short. Don't focus on complicated things. The things which you can easily understand, you have it with full clarity. Okay, and these questions will help you to do in a better way. Simple questions. For example, there is a 5-year bond with the duration 4.3 years. 5-year bond duration. Duration means up to how long we can hold the bond without being affected by changes in interest rates. So that is a concept of duration advocated by Macaulay. And the coupon rate is 7.5. The bond is right now quoted at 1,000 rupees per bond. And the interest rates going by 50 points. 50 points mean 0.5%. Now the question is, what will be the expected value of the bond? It's a balance sheet. It's anywhere you can take it. It may be a risk management. It may be treasury. It may be balance sheet management because bank has invested.
Sir,
Okay,
the
bank has
duration once
invested.
you please repeat, sir. Duration. What is
Duration means, madam, every bond will have a maturity period. Here in this bond, for example, I will use the laser. This bond matures in 5 years, madam. And within these 5 years, so many times the interest will keep on changing. Correct, madam? It's not a fixed rate bond, floating rate bond. Agreed? So whenever the interest rate, yesterday we discussed, whenever the interest rate goes up, the bond price will come down. The value of the bond will come down. So any investor, whenever the value of the bond comes down, he will be worried. It becomes a loss. So what is duration? How long he can hold that bond? Because longer he hold, larger is the risk. Longer is the risk. Correct, Immediately you should be able to sell the bond. You are coming out of the risk. But it's a long-year bond, 10-year bond mean. Till 10 years you have to hold the bond mean. To 10 years you are having a risk. It may go this way. If it is going up mean, no risk. Going down mean, it becomes a loss. So that is why the Macaulay, once economist, found out, yes, any bond, if it is floating, within a reasonable period, at the earliest, it may be a 5-year bond, at the earliest, the investor should get back the value. Afterwards, he will not be get affected. That is a concept of duration. Duration means how long he will take to recover the original investment he has made, because if he waits till long, sometime he may be hit by a loss. So that is why this concept of duration. Duration will normally to avoid market risk. What is market risk? Changes in prices. You have invested in a bond, when the bond value goes down, it becomes a loss. Okay, madam? So to measure the loss, there is one another formula. You see the question. The duration is 4.3. Now, right now, the coupon rate is 7.5. It is quoted at 1,000. Now, if the interest rate goes up by 50 points, instead of 7.5, it goes up. Now, what will be the expected value of the bond? Now, the bond price will, now rate of interest going up, bond price will come down. How much it will come down? What percentage will come down? From 1,000, whether it will go up to 1,000, it will be more than 1,000 or less than 1,000. That is the question they are asking. Understood? Friends, this is the question. So for this, the formula, this is a fundamental rule. When the rate of interest increases, yield rate increases, anything, coupon rate increases, bond price falls. Either increase, either decrease. Then when the price decreases, it is a loss for the investor. Okay. If the price goes up, it's not a loss. When the price comes down, you can sell at a lower price, though it becomes a loss. So the extent of loss, there is a formula. This formula is easy to remember. This is a formula yesterday we discussed. Now how to apply? Some of you had expressed a doubt. So I thought, yes, by giving one more example, you will understand in a better way. Now you understood. So the percentage change that you have to find out. How to find out? MD is a formula. MD. How to find out MD? D divided by 1 plus R. So D, first you have to find out D, MD. How MD? This will help you. This is your question in your treasury. MD, they will ask how to find out D. I think there is a flow chart. I think sir will have explained. Okay. So if it's a coupon bond, 3 year, 5 year cash flows, discounted value. So all those you'll have discussed to find out the bond and the duration of a bond. Now duration they have given. Now how to find out from duration? You have to find out modified duration. The duration divided by 1 plus R. 1 plus R. R is how much right now? 7.5. Then that will become 0.075. 0.075. So 0.01 plus R. So that will become, the duration will become exactly 4 year. 4.3 divided by 1.075 if you divide, will become 4 year. Now we apply the formula. So the percentage change is equal to, percentage change means it will not increase, it will decline. Why declining? 50 points is going up. So the price will decline. So 4, modified duration 4 into the 50 points, you have to make it a decimal. That is 0.50. 50, don't put 50. You have to make it a decimal. Decimal mean 50 points mean 0.50. So 4 into 0.50, 2. What is the meaning? 2% the prices will come down or go up. Now here the price will come down or go up because there is a 50 point going up. The price will come down opposite. So what will be the new price? 1000. 1000 is the current price. You put minus. Why you are putting minus? Because there is a decline. Minus, just to put 2 percentage button you put. This is the new price. This is the new expected price. The market always will react to sentiment. So the notional price of the bond after this hike in interest rate is expected to be 980. Click that one mark. Now how many of you understood?
Under 50 points means 50%.
50 points. That's a new way of expressing. Earlier days we used to tell 1%. Madam, those days, olden days, because of foreign terminology. Earlier days, what you will do, there is a price, 1% interest has gone up, 0.5% interest has gone up, 0.25% interest has gone up or come down. That is how we used to tell those days. Now the new terminology, because we are now a globalized economy, madam. So we are now capturing the global words. What is the global word? In foreign countries, they will not tell percentage. The interest rates have moved up by 40 points. 40 points mean 0.4%. Suppose 200 points mean 2%. 300 points mean 3%. Understood, madam?
But somewhere we studied, sir, 100 points equal to 1%, something like that.
Yes. That is why 100 point is equal to 1%. So 50 points is equal to 0.5%. 25 points is equal to 0.25%. So like that, earlier you used to tell percentage. Now you are referring as points.
Not equal to 100%. 100 points
No.
just 1%, no, sir. So
Yes. 100 points is equal to 1%. 1% is divided into 100 small points. Okay, madam? Okay. So 2% mean how many points? 200 points. 0.5% mean how many points? 50 points. Is a new way of expressing interest rates. Now repo rate has moved by how many points? Repo rates have moved by, normally used to tell 0.4%. Okay. Now also you can tell by 40 points. 40 basis points. Earlier day we used to tell basis point. Now the basis is silent. 40 points, 50 points, 20 points. Understood, madam? So the formula you remember. This is the formula. You are 2 formulas you understood. This will give you 2 marks. Okay. How to find out modified duration from duration and what will be the price change. This formula, 2 formulas will give you 100% 2 marks you will get in the, I think, Sunday exam. Okay. Now we are coming to next one. Okay. Up to this, only few questions remain. Then we will go to balance sheet management. Okay. Now, for example, Bright Bank Limited is the name of a bank. They are given export credit 1,200 crores. Okay. But their outstanding export credit 1,200 crore. It is all guaranteed by ECGC. What is the risk weight for this exposure? What is the capital needed? It's a simple question. But doing this simple question, you should have the background information. What is the background information? Yesterday I have shared with all of you. All ECGC guaranteed export limits, irrespective of the extent of cover. Oh my God. The risk weight will be 50%. This you keep in mind. So 1,200 you have given a loan. So the risk weight will be 600 crore. Then 600 crore mean capital needed will be 54 crore. Within 5 seconds you can do. But to do that, you should remember this. The 50%, if you don't remember this, so the answer will be wrong. Correct? You will be losing the mark. Okay, how easy it is. Agreed? So just like only these two words they will give, and immediately within 2 seconds you can calculate. Agreed? Understood? Okay. Now we'll move to next.
Sir, whatever may be the amount in ECGC, will be 50% only. Huh?
Yes. That is risk weight. Now risk weight means only for the purpose of calculating capital needs under Basel III. When the export credit is, all the export credits are mostly guaranteed by ECGC. Because we will give the loan, if the loan goes bad, like a MSME loan. MSME loan, if they go bad, we go to CGT SME, we claim. Similar way, export loans goes bad, it becomes a NPA. We will also prefer claim from ECGC, Export Credit Guarantee Corporation of India. They will settle something. How much they are settling? Normally they will be settling 70%, 66, 2/3%. For small exporters, 90%. Whatever be the settlement, for risk weight purposes, 50% is the risk weight. That means 50% of the export loans may become NPA. That is the point. Agreed? So accordingly, you have to apply the thumb rule. Accordingly, you are calculating the capital need. Agreed? Understood? So this will help you, madam. 1 mark.
Sir.
But if you don't remember this, you land in a wrong answer. Yes, tell me, madam.
Sir, where this 9% came?
9% is the by default, madam. 9% the default for calculating capital. What is the capital? That means if 600 rupees, 600 crore become the loss, to manage the loss, banks would have at least 9% of that loss to absorb the loss. That is Basel III. What is capital? Capital is needed for what, madam? Plainly speaking, capital is needed to absorb your loss in your business. Ultimately, whenever you suffer any loss in your business activity, bank is also a business, Whenever you suffer a loss, the loss has to be managed through your capital. First hit will be on your capital. That is why any commercial organization, to manage the risk, manage the loss, you should have adequate capital. Absorb the loss. You have to absorb the loss, Yes, that is the capital adequacy. Okay.
Sir, for any given question, hello.
Yes, madam.
Sir, for any given question, how to find out whether haircut to be taken out or not immediately after seeing the question?
Which one? I could not get your doubt.
Haircut, sir. Haircut regarding haircut.
Haircut, madam, haircut, don't worry. Haircut will arise only when you have taken collateral securities. Suppose you have taken gold and other security. By looking at the question, you will understand. I have given a lot of examples. You go through the examples once again, because till Saturday is there. My focus will be you concentrate on the things which you can easily understand. Now, right now, don't go into things. I know it's a big subject. There are so many complicated things you need to know. But now this is not the time to. Yes, aram se you go through. Okay, you will come to know. Haircut where it is applicable. I will give. I think balance it also. I will give examples. Okay, madam. So by reading the question, by practicing more question, you will come to know where haircut is applicable.
Remember the RW is little bit.
RW means risk weight. RW means risk weight, depending on the risk weight factor.
Yes, the risk factor is very tough.
The 50%. I have given, madam. I have given 1 second. Now I will again, yesterday I missed the class. Okay. Now this I have loaded at the end. Another few minutes wait. I will give the ready chart. I will give the ready chart. Okay. Now, one more question, small question. Yes, madam. Any of you have doubt?
No, sir.
Okay.
No, sir.
Okay. Just another few minutes. I will just give another summing up. Yesterday I did it. I think perhaps you may have missed it. So, for example, one more question. These are the questions normally being asked because some in CC account something will be drawn, something will not be drawn. I think this we have done. Anyway, still are you remembering? I just want to focus because this is a question repeatedly being asked. A firm enjoy CC limit 6 crore, but they have drawn 5.2. 5.2 they have drawn. So that means they can still draw 0.8 crore. Now, right now, this is liability. The 0.8 they may draw, may not draw, but still you have to find out the risk weight. So the rule is what the risk weight and what the capital needed for only one simple question. The CC account amount drawn is 5.2. They are asking RW capital charge. 2 line you have to. It's a 1 mark question. So first one is yes, something not drawn, and again it's a 6 crore limit. It's a FAM. So it comes under regulatory exposure. So the risk weight is this. You have to remember, sir. How to remember? Yes, you have to remember. The risk weight applicable for partnership and individual sole proprietorship and in up to 7.5 crore is called as the risk weight is 75. So now the 5.2 is already availed. 5.2 has become a liability. On that you apply 75. So that will become 3.9. 5.2 availed, you know. So the 75 risk weight you put. So 3.9.
Sir, this is CC limits, no, sir?
Yes,
Retail-
CC limit.
But why
Huh?
retail? But why risk weight for retail we have taken as 75%?
No. The CC is a kind of credit facility, madam. CC is a kind of credit facility. Is not necessarily a retail loan. Oh, don't think always retail loans will, yes. Retail loan mean that is given to retail borrower. But CC is a kind of credit given to small units. MSME unit also. They are MSME unit separate. Other than MSME unit, if you have given a CCOD up to 7.5 crore, it will be treated as for Basel 3. That retail loans are different. Here, for the purpose of Basel 3, it will be recognized as regulatory retail exposure. Okay, madam. So this is also can be brought within the purview of retail exposures. Okay. So that case 75 is the risk weight. So 5.2 is the amount drawn. Straight away risk weight will be 3.9 crore 75. Now the amount 0.8 is undrawn. The 0.8 is not drawn, unavailed. On that first you have to put CCF, credit conversion factor. The credit conversion factor is 20%. Yesterday we discussed. CCF, credit conversion factor. For the 80.80, 20% if you put, it will become 0.16 crore. It will become 0.16 crore. 0.8 crore, 20%, 0.16. On that again you have to put 75. On that again you have to put, now you have to put RW for this credit exposure. Then that will become 0.12 crore. So the total risk weight will be, that is why 2 slabs, 3.9 plus 0.12, 4.02 is the total risk weight for this CC account. And you know, there are 4 steps. Don't miss the step. Now, please remember in mute mode, please. When you ask the question only, please mute. Please, boss. Please. Otherwise, it's the noise. Always don't remain in unmute mode. First mute. Those who want to ask question only, you open. Then a question is over. When you are hearing, again don't remain in unmute mode. No, I think somebody is remaining in unmute mode. Please, you have to cooperate because others will get affected. Please remember. Okay.
Hello, sir. Hello.
If more than one people are keeping it open, then it will be a big issue. Now,
Sir, explain that unavailed portion again, sir.
unavailed
Please
means
note all.
1-10-21 വരെയാണ്
Unavailed
ഉള്ളത്.
20% and 75%.
Sir, too much noise is
Right,
coming.
I have missed it.
അപ്പൊ ഇതിന്റെ ബാക്കി തരാം.
Sir, please don't.
1-12
So you can mute everyone knows.
Please mute all, sir.
it's very difficult. Biju, you have to mute them. Biju, except those who are asking down, others are keeping.
പിന്നെയും വരേണ്ടി വന്നതാണ്. ഞാനും നോക്കിയില്ല. സോറി സർ.
Hello,
Some people
friends.
attending in branch premises.
Friends,
Please mute all.
please remember, it's so many people are online.
അല്ല
So one of
അത്
you,
പ്രിന്റ് ബ്രേക്ക് ആയി പോയി മാഡം. പകുതിയേ വന്നോളൂ.
Arya madam.
Arya madam, please, everybody has to cooperate because otherwise, because the online, no, so many people are logged in. Okay, and again, when the question is over, immediately you mute it. Please, otherwise, don't remain in unmute mode. Immediately mute.
Arya.
Okay, please. Okay, now okay, very good. Thank you. Now, the question is, some people are asking, because CC limit always, it will not be drawn to the full limit. Sometimes sanction limit will be 6 crore. You have availed already 5.2. So for the purpose of calculating this risk weight, the undrawn amount also has to be taken into account. But for that, first you have to apply CCF, then you have to apply risk weight applicable to the category. So these steps, if you miss, you'll get a wrong answer. So the 4.02 in this example is the risk weight. So the capital needed by default 9. So 36.18 lakhs is the capital needed for this particular account.
Sir, explain that unavailed step, sir.
20%.
Unavailed step you
undrawn
explain, sir.
amount when they are disbursing, they are not mentioned, no, sir.
No. They will not mention, madam.
next year.
No. That is for term loan only they will mention. CC account they will not mention, madam.
Directly we have to ensure they are going to
Yes.
disburse this year.
They will not mention because CC account, CC account anything they can withdraw.
Okay,
I
sir.
think. Okay, understood.
Sir, explain that unavailed step, sir.
Unavailed mean, madam, 6 is the sanction limit. 5.2 they have already drawn because the CC, cash credit, they can draw up to the DP or sanction limit. Sanction limit is 6. They availed only 5.2. So the 6 minus 5.2, 0.8. 0.8
That
crore.
I understood, sir. Next step. Next, sir, 20% and again to 75%. Why, sir?
That is applicable to the category, no, madam. You have converted to risk weight. You applied to the risk CCF. CCF means credit conversion factor. This yet to be availed, He may avail, he may not avail. So the 20% if you put, it becomes 0.16 crore. On 0.16 crore also, you have to apply the same 75 you have to apply, as applicable to the category. So 0.16 crore, 75% means 0.12 crore. So now 3.9 availed component, 0.12 for unavailed component. So the total risk weight will be 3.9 plus 0.12, 4.02 crore. So like that you got it.
Sir,
Understood?
why we have used 2 CCF here on unavailed?
Oh, only one CCF, madam. Only
So
one.
what this 20%?
This is the thumb rule. In CC account for the undrawn balance, undrawn amount, the CCF applicable is 20%. Only
Okay.
120% I
This
have
is
put.
for the thumb rule, and then this 75 is... Okay, sir.
Yes, 75 is also is as applicable to the category. Another few minutes you wait, I will show the consolidated chart. Understood or not? 109.
Sir,
Okay.
excuse me, sir. While
Yes, ma'am.
calculating the risk weight, only the securities which are, backed by some kind of government.
No. Now, right now, don't worry about the securities. While calculating the risk weight, now what is the security they have not given? So that will arise in a different case, MSME, ECGC, I
but
will give that.
you know,
Okay.
they will specify, no, that this is
Yes. Now, for
this back
calculating risk weight,
Hmm.
correct. Now, they are not given anything about security, na madam. Here, they have not given anything about security. So, here, you have to calculate this. This is the way. This is the way of calculating because it's a CC account. You
Sir.
don't worry about
Sir,
availability of.
Sir, CC limit, how comes a retail exposure? It is commercial, na, sir?
No. Madam, even retail borrower mean, what is the retail borrower? The opposite of corporate borrowers. Corporate borrowers are companies. Retail borrowers are other than, so the normally we assume that retail borrower mean housing loan, this car loan, only there. Okay, this also, okay, they may also, a small unit also can, a partnership also can enjoy a small OD limit. No, SME unit can, it may be a small sole proprietor. They can also enjoy CCOD. CCOD is a type of credit, madam. It is not only meant for corporate customer. It is also meant for other customer also. If you are running a business, you are also eligible for CC. Any manufacturing unit or any trading unit, they are eligible for. Those who are having current assets, they are eligible for approaching the bank for working capital limit. So the working capital limit is, the form of working capital limit is CC limit. Okay. Normally your impression is retail loan. Retail loan means car loan, vehicle loan, housing loan. That is not the only retail. Here retail regulatory exposure. It is different from your retail loan means individual. Okay. Here individual also included, partnership also, other than corporates, all are coming under what? Other than specified category, retail regulatory exposure is not retail in your classification. Okay, madam, understood now? Okay, even CCOD is also can be retail exposure. Retail means other than corporate customers, other than specified category. Is a type of working capital limit. Agreed? Okay, very good. Now, another simple question. Now, there is a standardized approach. CSA approach means the standardized approach for operation risk. You are familiar, but anyhow, I am giving a simple question. A bank earns 220 crores income in retail banking. Okay. 330 crores in corporate finance. Okay. Commercial banking, 110 crore. Okay. Now the question is, what is the risk weight under the standardized approach for operation risk? Because they are earning income. Okay, interest income, non-interest income by 8 segment of business. I think all of you remember, all bank business classified into 8 segments of business line. What is the first segment, you know? Yes, the every business segment, there is a risk factor. Beta factor mean market risk, operation risk. So that is a beta. Beta mean a risk factor they are assigning. They are naming beta. You don't know why is beta. So it's a risk weight assigned to every source of income. For example, corporate finance. You are giving loan to so many people. You are collecting interest income. You are collecting non-interest income. Because of some inadequacy in your systems and procedure, you may suffer a loss of operational loss. There are 3 risks you have to manage: credit risk, market risk, operation risk. This comes under operation risk. So you may lose something. Your income may be reduced by the problems on account of operational deficiencies. So that is why corporate finance is a standard assign. That is why standardized approach. The beta factor they are assigning is because high risk 18%. For example, trading and sale 18%. Trading and sales mean what? So many banks are doing trading transaction and they are doing some sale of securities. So that transaction is highly risky, no? So your income may be lost by 18%. For example, retail banking risk is slightly less. This retail banking I can understand. Retail banking means opening a SP account, current account, giving small loan to individual. That is called retail banking. That is Basel III retail regulatory exposure different. This is retail banking. The risk is only 12 beta factor. Commercial banking risk is 15 because commercial banking little more risky. The income may be eroded, loss. Okay, this is they are assigning this risk weight. This is also a risk weight. Payment and settlement 18%. Payment and settlement mean interbank settlement, interbank following the payment, you may lose because of some, yes, that is why 18. And agency services 15%. This you have to remember, friends. Please remember, if there are 8 segments, 2 plus 3, 5, one more. One more segment, retail brokerage 12. These 3 are 12, 18 are 3, 15 are 2. You have to remember, no other choice. Now, once you remember only, though there are 8 segments, in this question only 3 segments they have given. But the 3 segments, only under operational risk you have to calculate. No other risk. This is only to calculate operational risk. Bank and 220 crore. Okay, now you note down 220 crore under what? Retail banking. Retail banking immediately remember 12%. So 220 into 12, 26.4 crores may become a loss. We may lose, bank may lose 26.4 is a thumb rule. What to do? They have framed the rule. We have to remember. Okay. What is the meaning? On account of your retail banking business, the bank may get 220 crore, they have earned, but the likely risk is 26.4 on account of operational risk factor. What is operational risk? We may not be able to fulfill our terms and procedures. We may violate, deviate. Sometimes there may be a fraud, or there may be some password, some procedural guideline you have violated. On account of that, bank is suffering a risk that is called operational risk. Okay, friends, I think all of you know the definition. Now, corporate finance, they are earning 330, but NDR 330 not guaranteed. Some loss is likely. How much loss? The corporate finance means 18%. So 59.4 crore may become a loss. So this is the risk weight. This is the risk. This is the risk. Risk means loss. This may become a loss. Okay. The commercial banking 110%. So 15%. Okay. The commercial banking 110%. Okay. 110% income they are getting, but the beta factor is 15 because commercial, no, other than corporate. Okay, so other loan that we are giving, that is called all commercial banking activity other than corporate banking, 15% risk factor. So you total all this, the total risk weight is, yes, 102.3. This is the total risk weight. So what is the total risk weight under for operational risk alone, not for credit risk, under TSC approach? One example I have given. These are being asked. So this you have to remember. This I have given in the chart. Just now another few minutes wait. I will show the chart. So the capital charge, again by default, if you multiply, then you will get the capital charge. Understood or not? This is a simple question, but you have to remember. Income. Sometimes they may give 2 more, 3 more segments also. They may ask, yes, what is the total risk weight assigned for the operation risk? Okay. This is
what is this beta factor and risk weight difference?
Beta factor, madam, is a thumb rule. They assigned some risk, madam. Risk.
Okay. Is the same with the risk?
Yes, yes. Earlier we discussed, no, 20% risk, 30%, AAA rated mean 20%. Similar way here, because it is a different risk, that is credit risk. Here that is operational risk. So they don't want to call by a risk weight. They call it by a word beta factor. Beta. Again is a risk factor only. Beta factor is risk factor. So 18%. 3 things are 18%. You remember 8 segment, and 2 things are 12%. 3 things are 12%. Retail, assets management, retail brokerage. Only 2 things are 15. 8 segment. You have to remember this. They will not give in the exam unless you remember. You cannot do the answer. You cannot get the answer correctly. Sometimes you may get a wrong answer. Mark a wrong answer mean why to lose 1 mark unnecessarily. Agreed? Now, this is also a question repeatedly being asked. Calculating where value at risk. What is value at risk? You note down the definition. Potential loss. Potential here, yes, somebody is, sir, where is applicable? Please remember, when you are holding some assets, the value of the assets is frequently every interval. Sometimes some shares, I think all of you remember, the share market investments are highly volatile. Today shares will be, Sensex will be up, Sensex will be down. Reliance share today will be 800, tomorrow it will be 870, next day it may be 780, Infosys share. So frequent fluctuation in the market value of a share, to that extent, the investor will suffer a loss. And who is the investor here? Bank is also investor. Please remember, banks are also investing in money market, debt market, capital market, forex market, because they have to manage the money, the people money they have to manage. So in the process, banks are suffering a loss, likely to suffer loss, not, so the where is nothing but, note down the definition, the potential loss. The potential loss, yes, a investor or a bank may suffer by holding an assets, by holding which assets? Volatile assets. Use the word volatile assets. What is a volatile assets? The value will keep on changing over a time period. Time horizon they will use, time period. If you hold it for 6 months, risk is more. You hold it for 12 months, risk is more. If you hold for 1 month, risk is more. If you hold for 1 week also, risk is there. Because every day changes, agreed or not. Longer you hold, larger is the risk. So here they will ask, what is the where? Normally for every year, not exceeding 1 year they will ask. So the where formula remember. What is where? This will be expressed like this. V will be capital, A will be small, R capital. You see the question. A bank has invested 1,000 crores in assets. Assets mean maybe Reliance shares, maybe bonds, anywhere, anything the bank has invested, which are 5% volatile per week. Oh my God. Every week 5%. Every week 5% means you will be always under tension, no? When the price is going up, no problem. But the price is coming down, investor will be worried. Correct? Agreed or not? You have invested in a share. Your share price coming down, you will be losing your sleep. So similar way, bankers invest 1,000 crore and this 5% volatile per week. What is the where for holding this asset? For 1 year, if you are holding the asset, how much where you are going to have? Where mean value at risk. 1,000 crores, sometimes you may lose.
Sir, every time square root will written, na? Square root of time horizon.
This is the square root I cannot type. That is why I have written. Okay, the formula will be okay. The formula
Sir,
will be
monthly square root.
no, not on. Just wait. Supposing they are given per week mean here per year mean square root of 52. Note down first. Those who have got pen. If the volatility is expressed per week, to calculate per annum, square root of 52 you have to put. Why 52? Tell me. 52 weeks are there. Suppose saying, understood? Step number 1, everybody has understood. Here they have put per week and they have used the word per year. How many weeks are in a year? Tell me, boss. For 52 weeks, you can take 52 weeks. Suppose saying 5% volatile per day. Per day. And what is the per year? Okay. Per year means square root of 365. Square root of 365. But sometimes they will put one small message. The actual trading days are 250 days or 260 days. Then you should not put 365. 365 is the number of days, but the trading will not take place in every day, So that is why they are specifically telling 250 days mean, then you have to use square root of 250. Supposing monthly volatility is 10%. What will be the yearly volatility? Then square root of 12. Why? Every month, 12 months in a year. These things you remember. Formula is same. Where is equal to?
Daily means square root of 250 we have to put there. Daily means square root of. So monthly means 30 days only, no, sir?
No. You have to see the question. Supposing 5% volatile, per day mean 30 days you take. If it is per day, square root of 30 or square root of 25. But per week mean, per month mean, you see the question carefully. Sometimes they will give 5% per day mean, okay, 30 days in a month. Supposing per week mean, year mean 50, square root of 52. Supposing per month mean square root of 12. Per month. Agreed.
And this will ask fine for a year?
Yes.
Always for a year?
Yes. Okay, they will give like this. Now you have to read that question. No, 2 year and all they will not give. Maximum 1
He
year
said
only.
250, no sir. For what 250?
What is number of trading days, madam? Number of trading days. Suppose in 365, you know, sometimes Sundays you have to exclude. How many Sundays are there? 52 Sundays are there. Sometimes your Saturday also there will be no banking, no trading days. So Saturday also market will be closed. So including that, and they will
Sir,
give
if you are
exam.
calculating for week and months also, that number of days to be also reduced now, sir.
Yes. If they will give specifically, madam. If they don't tell you anything, square root of 30 you put. If they don't tell you anything, square root of 30. Roughly you have to calculate.
Sir, 250 when we have to put?
250, when they specifically mention trading days are 250, you mentioned you square root of 250 you put. Otherwise, if they don't mention anything, square root of 365 only. That is permitted because the way you have to calculate, you have to read the question. Now you read the question.
For 365 they give year volatile, sir.
Yes. Here, madam, you see the question. 1000 crore, 5% volatile per week. Per week. So, simple formula. Value at risk is equal to rate of volatility in percentage. Okay. Percentage you remove. Percentage, rate of volatility always expressed in percentage into square root of time horizon. Square root I cannot bring. That is why I have typed square root. Okay. So here 5%, 5 you put, square root of 52. Why 52 I have put? So per week, the question your next line you read for an year. Per week for an year means square root of 52.
So suppose the year not given means? Suppose year not given means? Per week only
they will definitely give, madam. Otherwise the question how you can calculate? The where, they cannot calculate where just like that. What is the where they will not ask. What is the where they will not ask. Definitely what is the where if you hold the assets because your risk is dependent on how long you hold. Longer the risk. Agreed or not? If something is volatile, if you hold it longer, you are carrying the risk on your heads. Agreed, madam? So definitely they will give the period. 2 factors definitely they will give. What is the percentage of volatility per week and what is the duration of holding those assets? Definitely they will give. Otherwise, the question is incomplete. So the where formula, you remember, this is the formula. So 5% into square root of 52. Okay. So 5 square root of 52, all of you have to be very careful. First you key in 52, then you the square root button you put, you'll get 7.21. So 5 into 7. Here don't worry about the percentage. So 5 into 7.21, 36.05 is the value that may either plus or minus. Here the volatility means sometimes it may go up, sometimes it may come down. But you have to always expect the worst scenario. The prices may 1000 crores is the current value. So the decline in value may be 360.5 crore. That is 1000 into 36.05. 360 crore may be a loss. This is the loss. The value at risk is 360.5 crore may be a loss when you hold it for an year. So what is the capital needed? This is the risk factor where here no RW. Here instead of RW they will use the word where, value at risk. So different words will be used. So 360.5 crore is the value at risk. What is the capital needed? Yes, this is the capital needed. Understood or not?
Sir,
Yes, friends.
Sir. Sir, in between you said square root of 12, no sir.
Yes.
And that is per month given and per
Okay,
year.
one more question I have given. One more question I have given. Just wait. Whether this question I will say. Very good. This question, 400 crore in shares they have invested, whose prices are volatile by 10% per month. Okay, 10% per month. One madam was asking, what is the where for this exposure? Sir, they have not given a duration. So here is a bank. The month may have given. What is the where for this exposure is within bracket for a year. So here they have not given specifically, but definitely you have to assume because they have already given per month. Okay, madam. So the same rule, same formula, where is equal to rate of volatility per month. Now square root of how many you will take? Square root of how many you will take, madam? 12 you have to take. Why 12? But they have given per month, you know. Supposing per day, where per month they will ask. Per day, per month means square root of 30. Again, they will give trading days. If they give specifically.
Per year means, sir, per year means how much we have to put?
Square root of 12, madam. And per month they have put in, madam. 10
per
per month
means 12 we are putting, sir. Per month means?
Per month.
Year, no, per year means?
Per year mean? No. They will not give per year. No. Volatile per year. No volatility per year they will not. Maximum volatility normally for a period of 1 year only. So the volatile by 10% per month is the maximum. Per year will not arise. Oh my God. That will not arise. It may be either per day or per week, per month maximum. Then where for 1 month, 1 year, okay, or 1 week, that is a maximum. Okay.
1 year means 12 months we have to put, sir.
Yes. So
understood.
if they are expressing per month means square root of 12. Agreed or not?
If it is per month, we have to put it square root of 12, and if it is per year, then also square root of 12 only.
Yes.
That is my doubt actually.
Here, 10, no. The
percentage will be the exact value, sir.
Volatility cannot be per year, boss. Volatility not measured per year. That is for other purposes. For purpose of calculating where the volatility will be either interval. The interval of volatility either per day or per week or per month. That's all. Not per year. Okay. So per month mean where for the year mean here it is implied that 1 year. So 10% into square root of 12. Yes, madam.
Taking it is only the volatility for that particular period, whatever it is, 6 months or.
Yes. They will give, madam. Don't worry. Read the question carefully. So here month mean what's the where for this exposure? You have to, here it is implied that 1 year. So that is why the same formula where is equal to 10% into square root of 12. Square root of 12 is I think 3.464. So the 10 into 3.6 34.364. How much you have invested? 400. So your loss may be in a worst scenario maybe 400 into 34.64 because 1 year no. You are holding for 1 year. My God. So the longer you hold, larger is the risk. So the bank may end up with the loss of 138.56 crore. Then in that scenario, what is the capital charge needed for this risk? Days are 25. Then square root of 25 only you put. Don't put 30. Sometimes they will ask, what is the where for holding these assets for a year? Year means 365. But they will give within a bracket number of days are 250 days. Then square root of 250 only you put. Okay, understood? So read the question carefully. Follow the rule. You are highly successful. Wonderful.
Here we have calculated for per annum, sir. We are multiplying square root of 12 means.
That is, madam, annum, madam. So here per month mean how many months in a year?
12 months.
How many? That is why square root of 12.
Okay. So whenever they asked for exposure, we have to calculate annual VAR.
Yes. Remember the formula. Simple way you can calculate. Here sometimes
they asked for 1 day exposure. How we have to do, sir?
They will tell, madam, 1 day volatile. 1 day volatile. They will tell daily it is volatile by 5%, 2%. Okay. Then what is the VAR for 1 year? What is the VAR for 1 month? That's all. So 1 month.
Sir, if they even like this case only, they have given month volatility 10%. If they ask to calculate for VAR for 1 day, then how, sir?
1 day. This the formula is okay. Oh, you are asking that question. Here, VAR is okay. So here there are 3 factors, madam. VAR, rate of volatility, square root of time horizon. Out of that, 2 they will give. Madam is telling the rate of volatility per month they will give. then what is the rate of volatility per day they will ask.
Yes,
So
sir.
the same for 30 days rate of volatility is this. So for 1 day you have to divide by 30. So any of the 3 factor. Okay, supposing the 30 days mean this the 3 variables are there. This is one variable, this is another variable, this is another variable. Sometimes they will give 2, other 3 you can calculate. So here they have given this. Sometimes what they will give, rate of volatility per month they will give. What is the rate of volatility per day? Then square root of 30 only or 25. So you have to apply the formula is same. Formula is same. You want any question on that? That I have not framed. So sometimes they will give rate of volatility per month they will give. What is the rate of volatility per day? Okay. So that means again you have to divide by square root of that number of days. Okay.
Sir, for year we have to calculate its square root of 365.
Yes, 365. Or if they give specifically, you have to use that days. Okay. Read the question, madam. Easy. So it's like A is equal to BC. So either AB they will give, you have to find C. C they will give another 2. So it's like a mathematical equation. Mathematical formula, any 2 values they have given, the third value you can find out. Okay. But the formula is same. Okay, friends? Okay. Now, this is another question. 1 year they had asked, people are confused. You read the question carefully.
Sir?
Gradation.
Sir?
Yes.
Sir, can you please work out one question like 1 day volatility? How to find 1 day volatility from 1 month volatility?
Okay, I will include. When you come, I think 8 o'clock, I will include 1 day. How to calculate for 1 day? I will give one live example. Treasury is actually a treasury subject, but I will add one question. Today, 8 o'clock, you are coming, no? Definitely, I will ask, add one.
Thank you, sir. Thank you very much.
Very good, very good. Good.
Sir, if it's in days, I think it's in square root of 365.
Just right, I will give. Yes, I have understood your this one. So I 2 questions. One more question also I will add, so that you will have a complete clarity. Okay. What is monthly volatility, daily volatility, yearly volatility is this. What is the monthly volatility? So they will come downwards. Okay. Yes. Just I will just wait. I will give one question on that also. Yes. When I come next, I think maybe 8 o'clock. Okay. Now you see the question. One important question, but most of the people have missed it. Bank ABC having 400 crores in 20% risk category. This sometimes downgrading one small question they are asking. But the too many percentage, you read the question. 400 crore in 20% risk category, 600 crore in 50% risk category, 100,000 crores in 100% risk category. This is a total 1,000, 600, 400. 2,000 crores they are having in 3 risk categories. Understood? Now downgrading takes place, because this question sometimes they are asking. Downgrading means 20% of the 20% risk category. You see the words carefully. 20% of the 20% risk category. Now how many 20% risk category? 400. 400 is the original 20% risk category. That means 20% of 400 is 80 crores. So the 80 crores will come down to next lower grade. You see the question. 20% of the 20% risk category and 50% of the 50% risk category. Now 50% risk is 600 crore. 50% of this 50% risk category 300 crore. So the 300 crore will move down. This is the yes understood. Similar way. So the simple question, but don't get confused. You understood now? So originally, now I will how to demo. I will give a demo. So the first before downgradation. Now the question you see, downgraded to the next lower grade. Next lower grade. What is the new capital needed and what is the additional capital needed? What is the new capital or additional capital? Because of the downgrading, now it requires more capital. You agree or not? When it comes to the worst category, lower category, it attracts higher risk. So higher capital is needed. Yes. Now first one, before migrating, you have to calculate. What is the before migrating? 400 crores in 20%. So 80. 400 into 20%, 80 is the risk weight. And 600 crores in 50% risk. So 650, 300. Okay. Yes. Then 1000 crores in 100% risk. So 1000 crores. Yes. 1000 into 100,000. So the total risk weight will be, though the total is 2000 crore, 1600, 2000 crore assets, but the risk weight will be 1380. Agreed or not? So now what is the capital needed? 1380 into 9, 124.20 is the original capital needed at this point of time. But what happened? Maybe in next year or next quarter, there is a downgrading.
Oh.
What is downgrading? Yes, 20% move down to 50% category. 50% of 50% is category, move down to 100% is category. Now the assets will be reconstituted. Now what is the reconstituted asset? Now how much will remain? 320 will remain. Why 320 is remaining? Tell me, boss. Why 320 is remaining? 80 will move down. 20%. 80, 20% of 400 is 80. 80 will move down to this one. This will become 680. This will from here minus, here add. So the 320 now is the new 20% risk category asset, because 80 have moved down to this one. Here what will happen? Why 380? First 300 is 600 plus this 80, 680. But the 600 may 50% has moved down. 600 may 50% how much? 300. So the 680 again 300 will go down to next grade. So the next grade will be how much? 1000 was earlier. Now 300 will be added. So 1300. Now you total it. You will get 2000. You will try it. Now also you are getting 2000. Earlier also you are getting 2000. Now the new total assets are 2000, but it has undergone a change. It has undergone a change because of downgrade. Okay. Now this is remaining 320.
Sir,
So 320 into 20.
380, how you got, sir?
Madam, 600, 80 will come from this level to, it will be added to this category. So it will become 680. Then the 600 may, you see the question, 50% move down to next category. The 50% risk, if 50% of the 50% risk category get downgraded to the next lower. So this 600, 50% how much, madam? 300. So the 300 will come down here. So the now 1000 earlier, that will become 1300, no? 50% of...
So then 30%, it will come into 30% risk weight category, no?
Which one?
80 of accounts will come to 30% risk weight, no? Next category of 20%.
No. Here, that is correct, but here they are given only 3 category bars. Here, that is correct. Here the spread of asset, only 3 category of assets. 20, next is 50, next is 100. Okay? In the normal scenario, there are no borrowers in 30%. The next category of borrowers are 50 category. So it's straight away it will come to what? 20. So this particular bank, the assets are only in 3 category. So the next level will be, next lower mean, okay, your question is correct, but it will come to 50%. Okay? Then 50%, it will go to 100. So that is why reconstituted assets. Earlier 400, now 320. Now earlier 600
came down for 300, no?
Yes. 300 has come down, no? 300 has come down. 80 is on account of this fellow. This 20%, 80 is down here, no? 400, 320, 80. That 80 has moved down to next lower grade. Out of the available basket, there are 3 baskets. And so it is moving to the next basket. Okay, understood? Now you total it. Now also 2000. Now the risk weight will be 32 into 20, 64. 380 into 50, 190. 380 into 50%, no, 190. 1300, 100. So risk weight is entire 1300. You make a total. You make a total mean 1554. Earlier risk weight was 1380. Now risk weight has increased by something. So now what is the new capital? New capital will be 139,886. What is the new additional capital? You minus it.
15.66.
Yes, that is the answer. To get this answer, oh my God. To get 1 mark, how you have to struggle. That is CIB. Understood or not? Okay, friends, this question also. This question is easy. Okay.
So
The Bharat Bank.
once show the previous slide once.
You, madam, please. Okay. Okay. Yes. Okay. Yes, madam. Where is the doubt, madam? You tell me which area you want a doubt.
Sir, she want screenshot, sir. Just.
Oh, screenshot. Okay. 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 This I will share with you, madam. I think I have loaded. I think Biju has. Okay. Yesterday missed the class. Okay. Biju has already.
Already shared.
Yes, sir, they uploaded.
Shared. Okay. This is just for quick revision. Now at this point of time, don't get confused. My simple appeal to all of you: be clear in what you are, because what you are understanding in the last minute, that will give you more marks. This is my guarantee. And this is my experience also.
Once again, can you explain after downgrading how it is coming, sir? 64.
Earlier 400, 600, 1000, madam. After downgrading, 20% will move down to 20% of 400 is 80, na madam. 20% of 400 is 80. So 80 you minus it, 320. The 80 will come down.
It is given clearly.
Now the 80 will come down to 680. But here also 50% will move down to, yes. So here 50% of 600 has come down to this. So it's a reconstituted assets. After downgrading, this will be the position of the assets. Before downgrading, this is the position. After downgrading, this is the position. 2000, 2000. Now you have to recalculate. It's a wonderful question. If similar question comes, don't miss it.
Okay.
Agreed? Yes, yes. Okay, that is why I given. Because this type of question, downgrading. Yesterday we saw, chart. They will give a chart. 5-mark question. So now a simple question. 2000 crores NPA. Provision available 500. All right, great. Provision available 500. Then what is the capital needed? Now indirectly they are telling the provision available is what percentage, friends? I think 25%. It's 25%. So 25% means risk weight will be 50. Very good. More than 20. So you have to remember this. You have to remember this. Otherwise you cannot do this exam. This question will miss. So how much capital needed for this example? 200 into 1000 is the capital. Okay. RW is 1000. Okay. Yes. Oh, provision available 500. So it is RW is 2000. So 2000 into so here 100. So 2000. Now 180 crore is the capital. Easily you can do, but you have to remember the rule. Okay. This it may be one more question. Now this is one small point I am wanting to tell. Now restructuring has taken place as per IBC rules. The insolvency and bankruptcy code has come into existence. Yes, boss.
From NPA, we have to reduce the provision amount also, no? There are we need to apply the risk weight. From NPA, in the previous question, from NPA amount, we need to reduce the provision amount also, no?
That is for a different, boss. That don't get confused. That is for NPA provisions. Here for risk weight, that will not come into the picture. The percentage of provisions available, depending on that, you have to apply the risk weight. So you need not have to minus and all. The level of provisions, that is the decider for determine the risk weight. Now, what are the three risk weight, boss? 150%, 100%, 50%. So NPA account only 3 risk weight. Okay. When the provision available is less than 20, 150%. Yes. So you need not have to calculate. So they will give, but if the provision available less than 20%, you need not have to minus and all. Straight away, the risk weight is 150%. If the provision available is more than 20, less than 50, straight away risk weight is 1000. It may be anything. And if the provision available is 50% and above, the risk weight is again 50%. So there are 3 slabs. These questions definitely be asked. FAQ. Okay. Yes. Now you simply remember the restructured assets, stressed assets. They use the word stressed assets. You need some additional provisioning. That's all. What is additional provisioning? This you keep in mind. They may theory question only. The RP means resolution plan. Any bad account, you should not kill that company. before killing the company, liquidating the company, you have to find out whether the company can be given a new life. That is called resolution plan. The resolution plan is implemented within 180 days. So the 180 day review period, the 180 days you are giving, no? So during that period, 20% additional provision has to be made in addition to the normal provisions. Okay, this is, remember, 20% additional provision restructured. This is a question they are asking. Again, suppose in the resolution plan is delayed. The resolution implementation of the resolution plan is delayed beyond 180. Another 90 also they can go. Sometimes they are going up to special ground. Up to 1 year also they are unable to implement. But the account is, yes, because unless you give treatment, the account will not become viable. No, the patient is still in the hospital. Okay, but you are yet to give the treatment. So you have to keep an additional provision. Similar way, so if it is not implemented with 180, additional provision 20. If it is not implemented beyond 180 also, another 15% additional provision. So the 20 plus the 35% additional provisions are required. This you keep in mind. Sometimes theory questions will be there. Agreed?
As per I.
Hello?
Yes,
boss.
Sir, as per IBC, maximum period is 330, right?
330. 330 or 3. Now I think IBC 2021 again some more changes have taken place, boss. Earlier they told 180. Now 180 plus 90 only they are allowing. 180, 270 only they are allowing. Earlier 330, yes, it keeps on changing. Now IBC 2021, 2021. Okay. So that is credit management.
Sir, for housing loan restructured asset will be 25% extra, no, sir?
25. That is housing, correct. That is the housing loan. Here for IBC.
Housing loan.
Housing loan. Very good. Restructured housing loan. I think I have covered. Okay.
Yes, sir. Yesterday
covered. You go through all that what we have discussed. Just the final point. Now one more question are also being asked.
One second, sir.
Previous question, huh? Okay. Yes, boss. Yes. This is the thing I will share with you. In IBC account, that is restructured. It is different from housing loan. Restructured housing loan different. Okay. Here restructured, yes, stressed assets, corporate assets, big loans to big corporates under IBC will be, the case will be in NCLT, National Company Law Tribunal. Okay, that is the credit management. But sometimes the balance sheet management also the question will come. Here the question is from risk management, because stress asset means is a risk, is a NPA. So those accounts you have to revival plan you have to implement. The revival plan is delayed, additional provision you have to make. You remember 20 normal additional provision 20 in addition to the normal category. And if it is delayed beyond 180 days, again another 15% additional provision 35. Why I am telling? Because sometimes they will ask question in respect of restructured accounts, what is the additional provision needed? So you keep in mind, you will be thorough. Okay. Now one more question they are asking. Sometimes you see the simple question, but people are missing. Sometimes it will be 5 mark. Don't worry. You see Tata Motors, risk management. We are managing our risk as well as our company's risk. Tata Motor is our company. They are raising ECB for 500 million to be drawn in 5 tranches. Tranches mean installment, and the LIBOR linked rate or some reference rate, floating rate, to be used in India for investment in Indian rupee and the sales. Why I am giving the case study? You should not lose 5 marks. You should not lose 5 marks. Investment in Indian rupee and the sales will be in India. What is the risk? 5 question. 1, 2, 3, 4. Very simple question. For why you lose 5 marks? That is why I am giving. Okay. What risk in the what risk? Not one risk. What risk the company faces in this case? Okay. Major, they are facing 2 risks. What are the 2 risks? Interest rate risk and exchange rate risk. Sometimes currency risk and exchange rate both are same. Don't get confused. Either they will call currency risk or they will call exchange rate risk. Both are same. And interest rate risk the company is facing. Now, the question second is, what is the ideal product to manage?
So once repeat, sir. Sir, once repeat, sir.
What?
Once repeat, sir. Repeat, sir. The other name of currency is.
Boss is the company is raising a foreign currency loan in dollar, but they are, I think.
Please mute.
Sir.
Sir, you please mute, you can hear.
Yes, I think they are muted. Tell me, boss. Tell me now your doubt. Okay, I will tell you. Boss,
sir.
When anybody is raising a foreign currency loan and using in India, and the foreign currency loans are raised in floating rates, and but the sales are in India, project is in India, and the revenues will be in rupee, you are facing two risks, mainly two risks. Other is, okay, major two risks are the currency risk. Currency risk means your loan will be in dollar, but you are earning rupee income. So the rupee has to be converted to dollar when at the time of repayment. That is called exchange rate risk, or also called as currency risk. The second risk is you are raising a floating rates. Suppose you are availing next time, you are not availing in one stroke. Next time when you avail, the rates may go up. The rates are going up, again it may become a loss. When the interest rates are going up, you have to pay more interest, that becomes a loss. The two last, how we can manage? In one product will manage two losses simultaneously. Two risks will be managed simultaneously. That product is called currency swap. That product is called as what? Currency swap. What is currency swap? It will manage both the risks simultaneously. Because this is a Reliance Tata Group, they are doing the same tricks. They will raise a foreign currency loan at a cheaper rate, and they will not undergo floating rate. They will not undergo any risk. They will swap it for fixed rate, and they will swap it for rupee. When they swap it for rupee, no, that is my exchange risk eliminated. When they swap it for fixed rate, there is no interest rate, because everything is fixed, Floating only gives you a risk. Already fixed means you are not having any risk. So both the risks they will simultaneously manage. So just keep in mind how it works and all, don't worry. These 5 points you will remember. Sometimes you may get all the 5 marks. Why to lose? That is why. Now the question is, what is the ideal product to manage the risk? This is a currency swap. Next question is, the company does export and earn forex, then which risk is eliminated? Then which risk is eliminated? Exchange risk is eliminated. Exchange risk is eliminated. Very good. Is there any alternate way to eliminate the currency risk? They will ask. They will alternate way to eliminate the currency risk. Yes. The alternate way is the ECB itself. The ECB itself, remember, the external commercial borrowing itself can be denominated in rupee. Sir, how it can be denominated in rupee? No problem. He will give dollar and he will convert himself, and he will give us to rupee. He will denominate the loan in dollar. Then we are easy. It's a good thing for us. We have to pay now in rupee only. So exchange rate risk is getting eliminated. Not interest rate risk. Exchange rate risk is eliminated because the loan is going to be denominated in not foreign currency, Indian rupee. So this is alternative way. Another alternative way is we are earning forex, automatically you can earn dollar, pay dollar, so your currency risk is eliminated. So this is an intelligent question they will ask. Next question is, what's the product that can be used for managing interest rate risk? Okay, exchange rate risk you have managed. Interest rate risk, which one?
ISWAP.
Yes. Which one? Yes, it will be either CAP or FRA. FRA means forward rate agreement. These are the product used for hedging interest rate risk. Remember, so CAP is here for regular, so many 5 or multiple transaction, but FRA is for a single transaction. Anyhow, we can manage the interest rate risk instead of paying. Okay, these are the 5 questions. You keep it in mind. If the question is asked, don't miss it. Okay, friends.
124 and 125, please एक बार बता दीजिए.
124 and 125, madam. The company is doing export, When they are doing export, they will start earning dollar. Well, the first question is, they are selling in Indian rupee. When they are selling in Indian rupee, when the loan is in dollar, they have to convert the rupee to dollar. But when the 124, they are already doing export. By doing export, they will earn dollar. When they earn dollar, the earned dollar can be used for repaying the dollar loan. Then there is no currency risk. You understand, madam? You are having a dollar loan. You are earning dollar. So risk is eliminated, no? Auto eliminated. Okay? Like your immunity. Okay. What is the second? What the second way?
ECB.
ECB means long-term loan, madam. External commercial borrowing. Remember, external commercial borrowing means is a long-term loan taken from lenders abroad. Lenders abroad. The lender will be outside India, but most of the companies, instead of borrowing from your bank, they are borrowing from outside lenders. Why they are borrowing from outside lender? The rate of interest will be cheaper, be flexible. They need not have to bother much about securities and all. Some companies are getting based on independent rated companies, and based on their corporate guarantee, they are getting the loan. So that is why ECB is becoming a very, very popular in India. But risk factors are there. For managing the risk, they will come to the bank. Bank cannot give any guarantee. Bank can only give some derivative product. What is derivative product? If they are facing a risk, they will come to us. Sir, I have taken a loan. These are the risk I am facing, interest rate risk I am facing. I am facing
This cap and FRI.
Cap means you don't worry, it's a derivative product, madam. Cap is a derivative product, is a CAP. Okay, CAP means there is no expansion. CAP, this is the word. Don't put a capital letter. CAP, there's a cap means ceiling for your interest rates. Cap is a interest rate derivative product. Interest, it will manage a interest rate derivative. This also they will ask how to manage in a multiple borrowing, in a foreign currency borrowing, how to manage the risk of interest rate. You can manage through cap. When you are investing, it is floor. These are all derivative product. Yes, cap you remember for a borrower to eliminate the risk in interest rates. The interest rate goes up, will be protected. Okay, that is cap. Cap means ceiling. And what is FRA? Forward rate agreement. Is again a derivative product used for managing interest rate risk, not exchange rate risk. Forward contract, option contract, yesterday we discussed, that will manage exchange rate risk, but the FRA will manage interest rate risk. FRA, forward rate agreement. For a future transaction, this is a rate. Supposing the actual rate goes beyond, okay, he will get a compensation. That is a benefit of FRA. FRA, you are getting FRA. If the interest rate goes over and above your FRA, that is a fixed rate, you will automatically get a compensation. So your loss will be minimized. This is a derivative product. How it works is very difficult. Yes, right now you don't worry. You remember this nomenclature and the name of the product. That may help you to score 5 mark, 2 mark in your exams. FRA is meant for short-term interest rate. Cap is meant for managing long-term interest rates. That is long-term borrowing interest rates. Okay, FRA up to 1 year it is valid. You can manage interest rate risk up to 1 year, like forward contract. But cap will make you manage even up to 5 years, 7 years, multiple borrowing, multiple drawdown, all will be managed by a single product that is called cap. Suppose you are investing, that is called floor, FLOR, OOR. Suppose you want to combine both, HOMBO, you manage both, that is called collar. These are all the highly exotic product that they will not ask in this. Sometimes they are asking for advanced, your elective subject, if you are taking international finance and all, this complicated, tough questions will be asked. Okay, madam, understood? Don't miss 5.
That means that means there are 2 forward contracts.
Yes, yes. There are two products for managing exchange rate risk, forward contract and option contract. Similar way for managing interest rate risk also, There are so many products, but the very popular product is FRA for up to 1 year, CAP for more than 1 year.
Okay, sir.
CAP.
This much is enough. No,
Yes, yes,
no
yes.
need.
Ah,
Don't
yes, yes.
want to
Now,
drag
yesterday,
times.
yes, correct. Now, yesterday I had given this again. I think all of you are familiar with that. On the chart, ready-made chart, risk-wide, standard. What I remembered, what is popularly being asked, I have given a loan guaranteed by central government 0, loan governed by state government 20, AAA rated 20, AA rated 30. This is a ready list. Just go through that. Okay. Yes. Yes. Now, RW up to 23 cases. Commercial real estate 70%. Commercial real estate is different. Housing loan 70%. 50% for the NPA 3 category. 150 and 150. Retail related exposure up to 7.5 crores, 70%. And this is the business line and beta factor. Corporate finance in 18, trading and sales 18, and retail banking 12, like this, 8 segments of business. This is your ready chart. Already I have given the ready chart for CCF. CCF already I have given the same sitting. You go through that, that will help you to understand. So this is, I think, what we have missed to discuss today, yesterday. I have given a yes, because these are the, I feel you should all score nicely, because by, okay. So thank you. Now we are, I think now one, can I start the balance sheet management also? Because you have a session in another session you have, or next session only 3:30. Next session is at?
Next session 3:30.
I will only come. Okay. So can I go for another half an hour also? Don't worry. Yeah? No
Yes,
problem.
sir.
Okay. So up to risk management, this I have uploaded. Now you go to, okay. Now I have kept it ready only.
Can I ask
Yes.
just after downgrading now, sir? 320, how, once again, can you just explain, sir?
Oh, madam, earlier it was 400, madam. 400 was the 20% risk. I'll 20% of 400 is how much, madam? 20% of 400, 80. So the 400 will be reduced by 80. 80 will move down. It will not go anywhere. So you from 20% risk category, AAA category, moves to A category. That is A category. A category means 50%.
It will come, no, sir? 320.
It will come down to 400 will become 320. That 500 will become 500 or 600. 600 will become 680. Again 300 will go down to 1000. So 1300. Totally, the total assets will not undergo a change, but it will be regrouped. Regrouped in something will remain in AAA. Something it will be like that, migration to next lower grade. Okay, very good. That day we discussed, Now,
Sir, different
yes,
time buckets you are going to explain this.
Yes. Now that is a balance sheet management, madam, and coming. Now all of you are seeing the screen, yes or no? All I have to share again. Are you seeing this? Yes. BS management in bank, a quick revision. Yes, because again a big subject, but I have selected very, very important, commonly asked question. For example, question number 1. Very simple question. What is your off-balance sheet exposures for a bank? Bank is preparing a balance sheet, but some product will not appear in the balance sheet. It will appear on the notes to account. It will appear in the notes to the balance sheet. That is a balance sheet annexures. What is that account? Letter of credit. How much letter of credit you have issued? It will not be reflected in the it will not be reflected in the main balance sheet. Guarantee issued will not be reflected. Bills go accepted will not be reflected. What is bill go accepted? You are a buyer. You are acting. You are to give a protection to your buyer. You are also signing. You are also putting your seal in a bill of exchange. Buyer is already accepting. Bank is also accepting. Buyer's bank, that is called bills co-accepted. And outstanding derivative contract, that is also a contingent liability. These are also called contingent liability. These are also called what? Contingent liability. These are familiar. Also called, the first 3 are called non-funded credit. The first 3 are called non-funded credit, but it's not a credit, it's a hedging product. but the four are called off-balance sheet exposures for a bank. Agreed? Number one. Well, simple question, we will go fast. Now, a simple question number two, how NII is calculated. They may give a live example also, they will give a balance sheet also. What is NII? Because every bank works for NII. What is NII? Net interest income. What is net interest income? The answer is interest income minus other income, you don't worry. Commission, broker, that is all only interest income minus interest expenditure. Or interest income from loans, interest expenditure towards deposits, except current account. Except current account, all deposits, you have to pay a cost. SP account, you have to pay a cost. So the interest income minus interest expenditure is the definition of NII. Now here, so many questions they will ask. Just wait. If the interest rate goes up, what will the impact in NII? Because every bank is worried about NII. Because that is the big issue for every bank. Agreed? Okay. Now NII, I will give a calculation. Yes. Simple only, don't worry. What is NII? How calculated? You see the balance sheet. Current deposit 240 crore. SP 3.5. That is within bracket given is rate of interest 360 crore. Term deposit 6.5. 900 crore. ECGC claim settled 120. Here they have not given anything. EC claim settled, it will be a liability. But whether you have to pay any cost, no. This is we need not have to pay any cost. It is like a suspense account. Okay, liability. And refinance, this is a cost. Refinance may be from RBI, maybe from NABARD, maybe from SIDBI, maybe from IDBI. Okay, so that refinance, Exim Bank, all this refinance is not free. You have to pay some interest. Okay, so that is 8% within bracket they have given. Capital 12% they have given. You should not confuse you. The capital will not come in the NII. NII is what? Net interest income. So the capital earning, nothing will come. Understood? Okay, now assets. You total it. This is a balance sheet. So here they may give or sometimes they may give like this. Sometimes you have to consider the balance sheet. Based on the data, they will ask, calculate the NII. Here I have given the together, but sometimes they will not give together. Like this they will not group. You have to immediately understand. Current deposit you put this side. Savings bank you put like that. You have to regroup. Suppose cash also they will give all jumbled. Cash 18 crore. Cash 0 income. These are all income. This is the expenditure. Here SLR security income. Though it is a mandatory, it is earning 6% income. Loans and advances 9%. 840 crore they have invested. Fixed assets, that is land and building, furniture and fitting. Though it's an asset, it doesn't earn any income. NPA, sometimes the NPA they may give separately. Sometimes they may NPA, they will not give separately. If they don't give separately, that also you have to charge. Normally, now they are giving because NPA is very sensitive, you know. NPA, once it gets classified, you cannot recognize any income. So that is why NPA. HO account. What is HO account? The money due to HO or money due from HO. That is interbank. Interbank adjustment. That is also transfer price is there. But remember, it's not free. That is not free. Yes, it will also give you income because the money from transfer price. We will assume 8%. What is transfer price? The head office they will give a price to because it's an assets, you know. Then only your balance sheet will tally. You are having more deposit but less loan. Now you have to adjust more source. This is liability. This is assets. So HO account also. Sometimes HO account will come here. Then you have to pay interest. Okay, that is called transfer price. Okay. So all these okay. Now question is how to calculate the NI. NI how to calculate? The calculation come here. First you get the interest income. This is 0. Correct, you know. Income from assets only. Expenditure on liabilities. So you hear cash 0. Okay, 0. Next one 180 crore SLR. 1 year how much you will get? 180 into 0.06 you put. 180 into 0.06. Always 6% converted decimal. Take your calculator. 180 into 0.06. It will become 10.8. Okay, interest income. Then 840 crores you have given loans and advances. 9% is the average return. So 840 into 0.09 you multiply. Then you will get almost 75.6. Then fixed assets, no income. NPA, no income. HO account, transfer price will give you some income. So 760 into 0.08, that is 60.80. So 147.20 is the interest income on this. Okay. Now interest expenditure is current deposit 0. You need not have to pay any interest. So 360 into 0.035, that is 12.6. Then term deposit 900 into 0.065, 58.05. Then ECGC claim 0 and refinance 360 into 0.08, 28.8. For capital, don't calculate. Sir, 12%, no, don't calculate. So the entire interest income become 99.90. So NIA is the difference between this. Plus NIA is now positive. Sometimes it will be negative also. Sometimes it may be negative also because NPA is more mean. Sometimes it may become negative. Okay, if the HO account there is no price also, sometimes it may become. So here it is positive. So NIA positive, click is just an example. Because they will not give too big because your time is only 1 minute. In the exam, you have to use 1 minute to crack every mathematical problem. Okay, some theory question you go fast where you understood so that you need more time for mathematical problem. Okay, mathematical problem unless you attend, yes, your score will not improve. Please remember. Okay, simple questions only. So this is.
Sir, here, EC clients not issued, sir.
Yes, boss.
120 crores EC client settled there.
120 crore. This 120 crore where it is? Easy claim. This is. Here no interest you have to give. ECGC, they have settled it. It will be in our suspense account. It is a payable. It is payable. Immediately cannot adjust your loan account. ECGC claim will be parked temporarily as a liability in the balance sheet of the bank. Okay. Yes. So that is again exempt from SLR. We'll come to that separately. Understood? So NIA understood or not? Okay. Now next question is NIA.
Show the previous slide once.
Yes, madam. Yes, madam. Yes.
Sir, out of that, can you just quickly tell, I mean, this interest income and interest expenditure, which are the parameters we have considered? For example,
cash,
बहुत सारा पैसा है हम देख के इनका खाली लिमिट बढ़ाना भाई मैडम का जो
income you will as a banker cash and RBI balance. RBI is a current account, no? So though it's an asset, it will not give you any income. Please remember. So here the question of income doesn't arise. Here SLR it gives an income. They have already given the bracket. It doesn't mean here they have given in the bracket.
Okay.
So it's
Thank you.
here also they have given. So fixed asset they will not give because
हाँ हम साइन कर देते हैं काट दो इनका लिमिट दीजिए ना इनका लिमिट देख रहा है कि खत्म हो गया 1 साल का ही दिया हो सके
Mute all, sir. Mute all.
मैनुअली होता था ना तो 1 साल का सब हो गया
Sir Jaishankar, please mute.
पता नहीं क्या हो
Sir Jaishankar Prasad.
Yes. Please, boss. Okay. NPA, madam, by default you don't charge.
खाली डेट चेंज कर
Yes. So this is how you will pick up, madam. The current deposit they will not give. You know very well. No, don't have to pay any interest. EC claim also you don't have to pay any interest. Capital no. Refinance they will give. Rate of interest they will give. Refinance is not free. They will give. Understood, madam? So this is how.
Inside only SB and term deposit you took. Only SB and term deposit.
Yes, madam. Refinance also, refinance. Sometimes refinance they give. Refinance also you have to pay interest, Yes, it's not free. It's a money from maybe RBI. That also you have to pay. So that also will be affecting your NII.
Sir, this percentages how we arrived, can you explain again, sir? Network problem for me actually. I did not listen.
Which one, madam?
From the beginning, sir, all these percentages how you have arrived 10.87.
Madam. Please,
Sir, in SLR, if 6% is not given, then we have to consider that as income or not?
No, yes. SLR definitely they will give, madam. Madam,
LR
yes,
is
for the
definitely interest income only.
yes. One madam has missed it.
CRR
Madam,
is not.
the explanation is
Sir,
here.
interest income.
It is explained here. So you just
Sir,
follow.
lastly, you please repeat that, sir.
Which one?
Everyone has to wait now, sir.
Okay. One more time for everyone.
For us, no problem. But,
Okay.
many.
Yes, friends. Friends, every bank works for NII. Please remember, NII is the major concern of every bank. What is NII? How much income, interest income you are getting, how much interest income you are paying, how much interest expenditure you are paying. Normally, your interest income will be on loans, but your cash and all will not get you any income at all, though it's an asset. Normally, interest income will be on assets. Interest expenditure will be on liabilities. That is a common thing, all of you know. So now they will give. Here I have given the balance sheet, but in the real exam, they may not give like this. What they will do? Cash, 180 crore. And SLR security, madam asked a question, good question. Definitely they will give the rate of return. Okay. Sometimes they will give two type of SLR security. Government security, sometimes they will give non-SLR securities also, 6%, and which will be more. SLR security, the return will be less, but risk is less, zero risk. But in non-SLR security, return may be more, but risk is also more. So the return they will give, sometimes they will split into SLR security, non-SLR securities. Okay, they will definitely give the return. If they don't give, you cannot, they will definitely give. Then only you can calculate NII. But the fixed asset, they will not give. They will, instead of fixed asset, they will give furniture and fitting, land and building, premises of the bank, they will give. So you need not have to calculate. NPA, if they give separately, definitely you should not give any income. It will not give you any income because notionally it is earning income, is a suspense account. But really speaking, you will stop debiting interest income. Okay. And HO account, that is the money receivable from HO. Okay, it's a receivable, it's an asset, it's not payable. Sometimes HO account will come here also, HO account will come here also. If it comes here, it's an asset for the particular branch. It's an asset for the particular bank, HO account, that is a interbank account, 760 crore. On that also they will get income. What is the income? They will use this word transfer price they will use. They will not give interest and all. Transfer price is a transfer price is a methodology to adjust the price difference between various units of the bank. Some units will be service units, some unit will be branches, deposit oriented branch, some will be advance oriented branch. Agreed, friends? So this is your income segment. This is your expenditure segment. Current deposit means current account. Current deposit means okay. For the word, sometimes they will use the word current accounts. Current deposit means current account meaning 240 crore. That they will not give, zero income, zero expenditure. SP account 3.5. Okay, that is they are giving. Some banks are even charging 2. That is different, deregulated. Now, when they are given specifically, you have to calculate. And term deposit, average cost of the term deposit 6.5. EC claim is not we need not have to pay any interest. This is also a liability, but need not have to pay any interest. Okay, it's not a payable. No, it will not attract any interest. It will not involve any payment. And refinance 8%. What is refinance? Maybe from NABARD, maybe from SIDBI, maybe from yes, RBI, Exim Bank. So here they will definitely give rate of interest. Okay. The capital, just to confuse you, they have given 12% dividend. Is a dividend, is not interest. So capital, never get confused. That will not come in NII, net interest income. Okay. So now, so 18.0, don't worry. The 180 into 6, that is 10.8. 180, you take your calculator, and the 6, don't put 6. 0.06 you put. Always you practice 6%, convert to decimal, that becomes 0.06. 180 into 0.06 we multiply, 10.8 you will get. Then 840 into 0.09 if you put, you will get 75.6 crore. These are all in crores. These are all in crores because these are in crore mean income also will be in crore per annum. Then next one, fixed as, don't worry, NPA, don't worry. The 760 into 8%, 60.80. So the total interest income is for this balance sheet 147.20. Similarly, expenditure is current deposit, no, SP you have to pay, this 900 you have to pay, EC no need to pay any interest. So 180. So 3 segment only. So if you pay, you will get 99.90 is the interest expenditure. So your net interest income is what you receive is more, what you pay as interest is less. So you are getting a positive of 47.30 crores in this particular, yes, as per this particular balance sheet. This bank is happy. Why the bank is happy? NIA is happy. Agreed. Now, very hot will go to NIM also. But NIM is simple is NII, yes, NIM, always they will ask. NIM is how to answer. NII, just now you have got, divided by, how you get the NII? Because of assets, net interest income, average earning assets, not all assets. Okay, earning assets, if you divide, then what will happen? What is your net interest margin? This will be in percentage. NII is in quantum. NIM will be in percentage. NIM how calculated? Okay, how calculated? In the same example, already we have calculated the interest. The 47.30 already we have calculated NII. Now you have to divide by what? Interest earning assets, not all assets. So cash you have to ignore because it doesn't earn you any income. This you have to take 180 you total plus 840 you total. This you don't total because these are not earning assets. These are also not earning asset because they have given NPA separately. And this is earning, something is earning. So these three things only you have to total. Cash you don't total. 180 plus 840 plus 760. If you total it, you will get 1780. You
So
divide
we will
this
include
by
only the items we choose for this income side.
yes, interest calculations. Okay, madam. That only you select. Okay. Then you put your percentage button. You will get 2.66. Oh, so the net interest margin is 2.66. Pick up the answer 1 mark. They will give so many years they are giving live questions. Okay, they will not give like this. This is you have to first rearrange the data. They will give in a jumbled way, but you have to rearrange, group it. Assets this side. Assets only will give you income, and liabilities are only expenditure. You group it. They will give data. Then you calculate. First NII calculate. Then divide by interest earning asset. You will get NIM. Okay, madam. Wonderful. Okay.
So HO account will come in liability side on in asset
No,
side.
sometimes it will come on the liability side also, madam. It depends on the particular bank, or sometimes it will come on the asset side also. Sometimes it will be on the liability side also because sometimes it is receivable, payable.
If they don't give whether it is asset side or liability side, which we have to consider, sir?
No. Definitely, madam. Definitely. If it is appearing the definitely they will give receivable or payable. They will give. HO receivable. Receivable mean you put on the asset side. Payable mean you put on the liability. Very correct. Sometimes they will not just HO balances they will not give. Just HO balances they will not give. HO balances is payable or receivable. Payable mean you put on the liability side. Receivable mean you put on the asset side. Correct. Your doubt is correct. Okay, friends.
Sir, can you show the previous slide, sir? Just to.
Yes. You want to, madam? I will share with you. Don't worry. Today evening itself, on at 10 o'clock, I will send to all of you.
Okay.
Then you have got another